Google is up around 11% over the last 12 months, but year to date it has taken a bit of a hammering, down nearly 14%, worse than the S&P, which is only down a few percentage points, but it is trading near its 52-week low with a double buy from both Seeking Alpha and Wall Street, and we're going to come on to their valuation as well, which right now does look incredibly cheap. But one thing we have to point out is when we look at others in the Mag 7, they too haven't had the best of starts in 2025, with nearly every single one of them down double digits. And this is where things start to get interesting, because we want to understand whether or not we are looking at companies now with some attractive valuations, and one that continues to be in our face at a very good price is Google, which is sitting in the 16 to 17 region on a forward P basis, and that does make us want to dive further to understand whether this company is one that can have massive growth. And for many shareholders, it probably does seem like quite a long time away where this company was sitting above the $200 mark. In fact, it was just towards the end of January and not that long ago. We also heard breaking news yesterday about the acquiring of Wiz, the security cloud company, for around $32 billion. This is one that they have been trying to close for quite some time, and as we are going to show you, Alphabet aren't one to shy away from acquisitions, and we need to understand whether in part this is a good decision for shareholders, the company, and the long-term growth of one of their fastest growing income streams. We want to highlight here that over the last 10 years, they have had quite a significant cash balance, and it has increased from around $72 billion in 2015, now sitting at $96 billion. But as we just highlighted, 1/3 pretty much of their latest cash balance is being spent on Wiz security, and whether or not this is the right purchase for the company, again, questions like this need to be considered. But we do want to point out, if we look at their history, their return on invested capital, us whether management can effectively allocate their capital, is fairly strong. Not only has it been increasing over the last 10 years, but it does sit at 32%, so that can give us some confidence that management know what they're doing, the decisions behind the very large spending. And we can also look at their track record. For example, the 10 greatest acquisitions of all time, we do notice there are quite a few instances where Google has been mentioned, with the one that probably does capture your attention being YouTube, where they purchased for $1.65 billion, and this information from 2022 alone tells us that they returned off that investment $160 billion. That is nearly a 100x from their acquired date, but on top of that, it still continues to generate such a significant return, and we'll break that down into the percentage shortly as well. Now, for those that maybe Wiz is slightly newer to them, they are a cybersecurity one that was founded in 2020. They specialize in cloud security solutions, helping organizations identify and mitigate risks across various cloud platforms. Now, if we just dive into what this exactly means for the company, well, first thing to note, the way these shares reacted yesterday, they were down around 2.5%, although as noted here, technology companies and the broader market have been down quite consistently, but Google Cloud is behind some of the market leaders like AWS and Microsoft Azure, so it can help them, as noted here, to improve their cybersecurity capacity and compete better with their peers, ultimately trying to take more market share. And this is what is highlighted here by a more secure cloud can lead to more business, and that would ultimately boost their offerings and their value proposition to their enterprises. And one analyst, TD Cowen, are very bullish on this acquisition, where they in fact say they are the fastest growing company in cloud security with $500 million in annual recurring revenue. Time will tell whether or not this company will come under one of the greatest acquisitions, not just for Alphabet, but also for all time. But solely focusing on their valuation, as we already said, the cheapest Mag 7, one of the cheapest in fact across the wider S&P 500, but with a forward ratio around 18.2, that is significantly lower than their 5-year average of 22.3. In fact, over the last 5 years, this is one of, if not the cheapest, the company has been valued at. And when we look at this model based on that 5-year average P, what we can see, the blue tunnel indicated the expected fair price. It is increasing over time, something you want to see with companies you're investing in, but there is disparity around the current trading value and even the lower end of the expected intrinsic price, giving us a sense of severe undervaluation. And this is still a company that is growing at a very strong rate, year on year 14%, moving forward expected double digit. Now the sector is in comparison a lot lower at the low single digit 2 to 3%, and they are increasing their revenue, but a little bit lower than what they have done over the last 5 years at 17 and 15% respectively, whilst anticipating EPS to grow around 17% over the next 3 to 5 years, which is above the sector comparative at 12.6 and not that far off their own 5-year at 17.9. They also do have a very strong rating of profitability, which comes at an A+, gross margin 58%, above the sector at 52, above their own 5-year at 56, so we are noting efficiencies, and bottom line net income 28%, well above the sector comparative at 4, but also again above their 5-year average of 24.4. What this is highlighting is that over time, not only is their top line increasing at a double-digit rate, but they're also getting much better in their efficiencies. Their margins are improving, their gross margin, their operating margin, their bottom line net income, and they're also generating a lot more cash from operations at 125 billion, where over the last 5 years, this is sat low at 88 billion. Not only again here are they generating more cash, but due to the fact that we are seeing the net income get higher and higher, more of the dollars that are being made are going to that bottom line, and it's significantly above the sector, nowhere near in comparison at 358 million. We also want to highlight that Google has massively outperformed the S&P over the last 10 years, 479% when the S&P itself 175. That also holds true when we look over the last 5 years, 193 versus 135. However, when we look over the last 12 months, they are pretty much both in line. Yet year to date, as we stated at the beginning of the episode, the S&P, whilst both have been negative, is at a smaller rate, therefore it has outperformed, although we are just in the third month of the year. And as we can see from their latest earnings, their revenue is still up double-digit 12%. Even their search advertising and their ad revenue, which continues to get bashed about how Google search is dying, continues to grow at a very strong rate, and we can and will discuss the Google Cloud, which is their fastest revenue stream, growing at 30% on a year-on-year comparative. And as we just highlighted, noting efficiencies across the board, gross profit in the latest quarter up 1 percentage point, operating profit up 5 percentage point, and their bottom line net income up 4 percentage points. We also want to highlight some research from Morgan Stanley where they do talk about SMB, so small and medium businesses, and they want to understand what are advertising saying about Meta, Google, as well as a few others. In fact, what we're noting here in terms of the usage among the SMBs, that YouTube is up 13% year on year, Google search is up 15%, and we also notice the ROI, the return that the businesses are having on their investment for Google search is up around 4%. So there is no data at the moment, even though we are led to believe that Google search is dying, that can really pinpoint to any serious issues. If you did see Alphabet's latest earnings, one thing that really came under the spotlight that investors and the market didn't like was their capital expenditures, and as noted, by the FY25, they're expected to spend around 75 billion. Analysts were anticipating this a lot lower in the 50 billion mark, and therefore they did not like that, and the share price upon those earnings release did in fact drop. But we can also notice they have pretty much over the last few years been one of the companies that has spent a lot of money, especially on their artificial intelligence strategy, at least over the most recent period. However, one thing we do note, Amazon does seem to be the market leader, but as we highlighted, at least over the last 10 years, their ROIC has been very strong, and in fact, over the last 4 years, in the high 20s, low 30s. Now remember, they did purchase the Wiz cybersecurity company just yesterday. We did hear from that, and that is one way they are looking to increase their top line. Now at the moment, in terms of global market share, they are the third place, sitting at 12%, behind Microsoft at 21% and AWS at 30%, and hopefully over time they do want to see them grow to first position. That is ultimately what all of these companies strive to become. And not only have they been growing at a very fast rate at 30%, remember they are in number 3 with Amazon in number 1, but they're also outgrowing in the percentage wise AWS. In fact, they grew at 19% in Q4 2024. In fact, over the whole 2024, they're sitting in the mid to upper teens, whereas Alphabet have been growing at a very strong rate. We're talking the high 20s, low 30s, and this is something they do hope this acquisition can help them to continue to propel those numbers at a very impressive rate. We can also note, in comparison, Google Cloud, as already mentioned, is fairly small, and they only turned profitable from an income perspective in 2023, whereas AWS has been profitable on the income side for a very long time, and their revenues do not compare. In fact, in the most recent quarter, it did sit just under 29 billion. For Google Cloud, we saw this at 12. There are also other areas that we do need to consider for Alphabet. For example, YouTube is increasing around 14% year on year. Again, very impressive. Double digits are something we want to see, especially for growth companies, especially for companies in the Mag 7 that do ultimately demand a premium. And in fact, over the last 5 to 6 years, in terms of the money spent on advertisement for YouTube, we have gone from around 3 billion in 2019, now sitting at 9 billion. So they've managed to pretty much over the last 6 years triple this figure, whilst also, at least for this time in being, exceed that spending of Netflix. And why we've used Netflix is because you could argue they are fairly comparable, but very interesting to note, in terms of the streaming in percentage time of what US consumers watch, YouTube is number one. It's been growing at 7.5% in December 2022, and a few years later it now sits at 11.1, which, as we can see, not only number one in comparison to Netflix, Prime, Disney and Hulu, but also they were both the same in 2022, that is Netflix and Alphabet. Now we can see a clear leader holding strong at number one. And there's also the advertising revenue element, which in fact for both YouTube and Google search, as they are a combination under Alphabet, is higher than Meta, which compromises Facebook, WhatsApp, Instagram and Messenger here, and in fact Amazon advertising. As we just look at the most recent quarter for Google, this came in at around 65 billion, where the next highest was Meta at 47.3, something that is very consistent no matter which quarter you look at. Now the institutions at the moment hold around 40%. We notice around 49 billion worth of selling over the last year, but nearly twice the amount of buys, so clearly they are very bullish, something again consistent to note in the most recent quarter of Q4. Institutions bought more than twice than they did sell. However, something we do note is insiders continue to sell with around 12% ownership. We have 108 million selling over the last year, with just in 2025 sitting at $14 million. And we will show you, as always, for transparency, the most recent sale, in fact, was the director on the 13th of March. They sold around 200 shares, not that much, $33,000. Then you go back a little bit earlier in the same month, where the chief accounting officer sold around 1,400 shares, netting them $238,000. Now remember here, as we always say, insider selling, not typically a bearish signal. They sell for many reasons, personal and financial, but always do your own due diligence and don't copy institutions or investors. And the other thing that we want to say about this company that we always love, we always like to highlight, is their net debt to EBITDA, which does correlate to their balance sheet strength, is in fact very strong. The zero that you see across the board for every single year over the last 10 and expected over the next 12 months is the number of years it would take for this company to pay off all of their debt net of cash on hand, which, as we can see, highlighting a very strong balance sheet and something we ideally like to see from the companies we're considering in our own portfolio. The other thing to note is when we look at super investors, something we typically do on this channel every quarter where they release their latest buys and sells, they do hold pretty much a very large percentage of their portfolio in Alphabet. And if we were just to look at the number of super investors that actually hold it under the ownership count, Google has two effective ticker symbols, GOOGL, GOOG, which are just related to the different classes. If we were to add them up at 56, that would overtake Microsoft in the number one position, making it right now the most owned stock by super investors across the board. And the other thing we wanted to pinpoint today is when we look at stocks that super investors have been buying over the last 6 months, Google again comes very near to the top. In fact, GOOGL sees 11 buys from super investors, and if we look at the other ticker symbol, we have 8, so that comes to 19, which is just below Microsoft, which makes it not only the most owned stock by super investors, but the second most bought stock by the same super investors over the last 2 quarters. Now, just before we jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a 97 stock spreadsheet which highlights the stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation, where we do believe the intrinsic price sits at $226, as always derived from the DCF model for this company, and in fact we have the free cash flow year on year noted for the most recent full year of 2024, where it has grown at 20% year on year over the last 10 on average, and we've gone for 12% moving forwards. As you can see, we have a low, medium, high, 10, 12, 14, and as always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others, but based on the growth rate of 12%, the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. As you can see, 226, which does now indicate 40% upside. We'll also show you, for those that believe it should be a lot higher at 14%, it comes to 259, indicating 60%, and for those that want to be a lot more conservative at 10%, $197, indicating 22% upside. Now, what we typically do on this channel is take the median rate of 12% here, and we always apply a margin of safety, using 10%, executing on that, buying the company if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, then a buy at $203, then we keep going till it's near the current trading price. Now, it's not at 30% MOS just yet, but up to $170, you're getting a 25% MOS. So for Alphabet, we see somewhere between 25 to 30. With Wall Street, very bullish, $220 price target. This in turn translating to 36% upside. Now, what we also want to do in today's episode is show you what the margin of safety would be for someone who does want to be more conservative, or someone who perhaps believes 10% is the more appropriate rate. And what you will find is that there is still a margin of safety, not at 20% just yet, but you are getting at least 15% up to $167, so sitting somewhere between 15 to 20, but again will depend, as we ultimately say, on what you believe the growth of the company can be moving forwards. Do you believe there will be issues with their Google search? Maybe you want to use a lower rate, maybe you want a higher margin of safety, but these are things to consider as well as many others before executing on any company, whether or not that is Alphabet. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us as well on the Patreon, where we do cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.